There is something quietly powerful about a dividend. It is not the thrill of rapid price swings nor the lure of speculative gains, but the simple, steady assurance that a company rewards its shareholders consistently. Benjamin Graham understood this deeply. For him, dividends were more than just payments. They were signals of a company's financial health, prudence, and resilience. In a world where stock prices rise and fall on whims, where headlines can mislead even the most disciplined investor, a dependable dividend serves as a tether to reality. It reflects real earnings, tangible cash flow, and management that is committed to sustaining value over time. Yet Graham warned, not all dividends are created equal. Some are illusory, funded by debt or temporary profits, and can mask deeper weaknesses in a company's foundation. Today, investors are often tempted by the allure of high yields, chasing the next big payout without examining its sustainability. Graham's approach is different. He teaches us to look past the surface, to ask, is this dividend truly supported by earnings? Can it withstand economic turbulence? Will it persist over years, not just months? Through this lens, we begin a journey into understanding dividend safety and income consistency, exploring examples from Graham's own era, the lessons that emerged from market upheavals, and how these timeless principles can guide modern investors toward reliable, long-term income. But what Graham discovered about dividends was not always obvious, and some of the lessons he uncovered were counterintuitive, even to seasoned investors of his time. Benjamin Graham's philosophy on dividends was rooted in a simple yet profound idea. Income must be dependable, not just attractive. He believed that a high dividend yield was meaningless if it could not be sustained over time. For Graham, the true measure of a company was not in fleeting profits or momentary market praise, but in its ability to generate steady earnings that could reliably support shareholder payouts. In Graham's era, many companies appeared prosperous because they declared impressive dividends. Yet beneath the surface, some were stretching themselves thin, borrowing heavily, or relying on accounting tricks to maintain appearances. The stock market, driven by speculation, often overlooked these subtleties. A company that could not sustain its dividend over multiple economic cycles was, in Graham's eyes, fundamentally weak, even if its stock price looked attractive. Graham emphasized consistency over glamour. He preferred companies with modest but reliable dividends to those offering large, volatile payouts. Earnings history, management prudence, and financial discipline were critical indicators. A company that had consistently paid dividends for a decade or more, maintaining them through recessions and market volatility, signaled strength and stability. He also connected dividend reliability to investor psychology. Investors who relied on steady dividends were less likely to panic during market downturns. The consistent income served as a buffer against the volatility of stock prices, allowing shareholders to focus on long-term wealth accumulation, rather than reacting to every market swing. Even today, these principles resonate. Investors chasing the highest yield may be tempted by companies promising outsized payouts, but without analyzing their ability to sustain them, they risk capital loss. Graham's approach is clear. Study earnings, assess management discipline, and focus on long-term consistency, for it is this steadiness that truly protects and grows wealth over time. Yet Graham's lessons were shaped by real experiences, moments in history where income consistency proved to be more important than short-term allure. Benjamin Graham's understanding of dividend safety and income consistency did not emerge in a vacuum. It was forged in the crucible of real market events, moments that tested both companies and investors alike. Among the most formative was the stock market crash of 1929.
The 1920s had been a decade of exuberance. Companies flaunted rising stock prices and generous dividend payments, and investors, buoyed by optimism, often overlooked the foundation supporting those dividends. When the market collapsed, the consequences were brutal. Companies that had promised steady income suddenly defaulted, slashing or eliminating dividends entirely. Investors who had relied on surface-level appearances suffered significant losses. Graham observed that dividends without underlying earnings are fragile, and no amount of market optimism could protect them when reality struck. The Great Depression that followed only reinforced these lessons. Many firms that had seemed strong crumbled under economic pressure, while those with disciplined management, prudent debt policies, and consistent earnings continued paying dividends. Graham realized that reliability in income is a hallmark of a fundamentally sound company. It is not flashy growth, nor temporary profitability, but the steady ability to generate cash and reward shareholders that signals true strength. These experiences shaped Graham's approach to both defensive and enterprising investors. Defensive investors, often more risk-averse, needed assurance that dividends would persist even during downturns. Enterprising investors, willing to take calculated risks, still required an understanding of dividend sustainability as part of the overall assessment of a company's health. Through these lessons, Graham internalized a simple truth. Dividends are a reflection of a company's discipline, earnings quality, and long-term strategy. They cannot be separated from the underlying financial and managerial integrity of the business. But how exactly did Graham analyze dividend safety? The answer lies in specific metrics and red flags he scrutinized carefully. To Benjamin Graham, dividends were more than a number on a balance sheet. They were a barometer of a company's health. He developed a disciplined approach to assessing dividend safety, looking beyond surface yields to the underlying factors that sustain them. The first metric Graham emphasized was earnings consistency. He examined a company's profits over a period of 5 to 10 years, seeking steady growth rather than volatile swings. A single year of high earnings was not enough. It could be the result of temporary demand, cost-cutting, or even accounting manipulation. True safety, he argued, came from a proven track record of stable earnings capable of supporting ongoing dividends. Next, he focused on debt levels. A company might pay a generous dividend one year, but if it relied on borrowed funds to do so, that payout was fragile. Graham looked at debt-to-equity ratios and interest coverage, ensuring that the firm could sustain its dividend even during economic stress. Companies carrying excessive debt were particularly vulnerable when earnings declined, a lesson painfully learned during the Depression. Cash flow was another critical indicator. Graham preferred dividends that were covered by actual cash earnings, not merely paper profits. A dividend that drained cash reserves or depended on asset sales was a warning sign. Strong companies generated enough cash internally to fund dividends comfortably, leaving a cushion for unexpected downturns. He also cautioned investors to watch for abnormally high payout ratios. A company distributing nearly all its earnings as dividends might seem generous, but it left little room for reinvestment or emergencies. Sustainable dividends, he insisted, struck a balance between rewarding shareholders and maintaining corporate stability. Finally, Graham paid attention to patterns over time. Sudden spikes in dividends, especially if not accompanied by corresponding earnings growth, often signaled risk. Similarly, frequent reductions or suspensions of payouts indicated weakness. By carefully observing these signals, investors could separate companies with genuinely reliable income from those offering superficial appeal. In Graham's time, these analytical tools were crucial for navigating a market filled with volatility and uncertainty. Today, they remain equally relevant, providing a clear framework for identifying companies with dependable dividends and long-term resilience. Yet understanding the metrics is only part of the story. Historical examples vividly illustrate the difference between companies that endured and those that faltered.
To truly grasp the importance of dividend safety, consider the companies Graham observed during the tumultuous years surrounding the 1929 crash and the Great Depression. These examples reveal the stark contrast between superficial appeal and genuine financial resilience. Some industrial firms of the 1920s appeared prosperous because they declared high dividends. Investors were drawn to the attractive yields, convinced these companies were stable. Yet beneath the surface, many were heavily leveraged, relying on borrowed money or one-time profits to fund payouts. When the market collapsed, these dividends evaporated almost overnight, and investors suffered severe losses. The lesson was clear. A dividend is only as safe as the company's underlying earnings and financial discipline. In contrast, certain utility companies demonstrated modest but consistent dividends, supported by stable earnings and cautious management. Even during the economic turmoil of the Depression, these companies continued to pay shareholders reliably. Investors who prioritized stability over glamour were rewarded, enjoying uninterrupted income when many others faced sudden losses. Graham saw firsthand that consistency matters more than size. Modern parallels abound. Take, for instance, contemporary companies in sectors like consumer staples or utilities, which may not offer sky-high yields but maintain payouts through economic cycles. Conversely, firms chasing rapid growth or hype, whether tech startups or speculative REITs, sometimes promise high dividends that are unsustainable, echoing the risks Graham identified nearly a century ago. These case studies underscore a crucial point. Dividend safety is not about chasing the largest payout, but evaluating the sustainability and reliability of income. Companies that appear strong in good times can falter when conditions change, while those with disciplined management and stable earnings endure. But understanding historical and modern examples also requires recognizing how investor type shapes dividend expectations, a distinction Graham emphasized carefully. Benjamin Graham drew a clear distinction between defensive and enterprising investors, and dividend safety played a central role in both approaches. For the defensive investor, the priority was preservation of capital and steady income. These investors sought companies that demonstrated consistent dividends, stable earnings, and conservative financial policies. The goal was not to chase the highest yield, but to ensure that income could be counted on year after year, even in turbulent markets. Defensive investors relied on Graham's rigorous screening criteria, examining historical earnings, dividend records, debt levels, and cash flow to select companies that were unlikely to falter. The enterprising investor, on the other hand, was willing to take calculated risks to achieve higher returns. Graham acknowledged that such investors might accept slightly higher dividend volatility or invest in companies with growth potential. But he insisted that even higher-risk investments must be grounded in sound financial fundamentals. Enterprising investors could pursue above-average yields, but only after carefully analyzing whether the dividends were sustainable and whether the company could weather market downturns. Historical examples illustrate this well. During the Great Depression, many enterprising investors sought bargains in companies temporarily depressed by the market collapse. Some of these firms offered high dividends relative to price, but had shaky balance sheets. Graham's approach helped them distinguish between opportunistic value and hidden weakness. Defensive investors, meanwhile, focused on companies with modest, dependable payouts, avoiding losses and preserving wealth. Today, this distinction remains critical. Investors with lower risk tolerance still prioritize stable, consistent dividends, while those seeking higher returns must balance the allure of yield against the risk of unsustainable payouts. Graham's guidance shows that regardless of your strategy, dividend safety is always central to preserving capital and achieving long-term success. Yet, even with careful analysis, investor psychology can complicate the perception of dividend reliability, a challenge Graham understood deeply. Benjamin Graham understood that dividends do more than reward shareholders. They also influence investor behavior. Market psychology can exaggerate perceptions of safety or risk, leading even disciplined investors astray.
During Graham's lifetime, exuberance often led investors to chase high-yield stocks without examining fundamentals. When a company announced a dividend increase, the market sometimes reacted as if the business were invincible, even if earnings were declining or debt was rising. Conversely, firms with solid fundamentals but temporarily lower dividends could be undervalued, as fear and pessimism overshadowed their stability. Graham recognized that perceptions of dividend safety are often shaped by emotion, not reality. He warned against the trap of chasing yields blindly, a phenomenon now called the dividend trap. A company may offer an unusually high dividend to attract investors, masking underlying weakness such as excessive debt or deteriorating cash flow. Investors seduced by the headline yield might overlook these risks, only to suffer losses when the payout proves unsustainable. Modern examples echo Graham's observations. High-yield stocks in volatile sectors, speculative REITs, or tech firms offering generous dividends can lure investors into complacency. Without examining the company's earnings history, balance sheet, and cash generation, what appears safe may in fact be precarious. Similarly, companies that cut or temporarily suspend dividends during tough times are not always weak. They may be acting prudently to preserve long-term health, rewarding patient shareholders who understand the context. Graham's insight was that dividends are both a financial signal and a psychological anchor. For the thoughtful investor, understanding the true stability of income allows rational decisions, while ignoring fundamentals leads to reactive, emotionally driven investing. Recognizing this interplay between dividends and psychology is crucial for navigating both historical and modern markets. Yet, even with these lessons, Graham offered counterintuitive insights that challenged conventional thinking about dividends. One of the most striking aspects of Benjamin Graham's teachings on dividends is how often they run counter to conventional wisdom. He challenged the notion that higher dividends are always better, insisting that sustainability and prudence outweigh sheer size. For instance, a company might boast a 10% dividend yield while taking on debt or selling assets to fund it. To the casual observer, this seems attractive. Yet Graham saw danger. A payout unsupported by earnings or cash flow is a ticking time bomb. In contrast, a company with a modest 3% to 4% dividend but strong earnings, conservative debt, and consistent cash flow could provide far more reliable income over decades. He taught that moderation, discipline, and financial health matter more than flashy, unsustainable payouts. Another counterintuitive insight is the value of temporary dividend reductions. Companies that cut or suspended dividends during recessions or strategic reinvestment periods were often stronger in the long run. Graham observed that such actions, though unpopular, demonstrated prudence and foresight. Investors willing to accept short-term reductions in favor of long-term stability were often rewarded with more consistent and secure dividends later. Modern parallels abound. Consider technology firms, REITs, or energy companies that adjust dividends to preserve capital. Investors who panic at cuts often miss the bigger picture, while investors who focus on long-term sustainability benefit from resilient income streams. Graham's lessons remind us that stability trumps yield and foresight trumps momentary appeal. By embracing these counterintuitive truths, investors gain a significant advantage. They learn to see beyond superficial metrics, recognize hidden strength, and avoid being swayed by market hype. These lessons set the stage for applying Graham's principles in today's investment landscape. Applying Benjamin Graham's principles in today's market is both straightforward and powerful.
While technology, globalization, and rapid information flow have changed the investment landscape, the fundamentals of dividend safety remain timeless. First, review a company's earnings history. Look at profits over the past 5 to 10 years. Are they consistent or marked by volatility? Temporary spikes or drops can be misleading. Sustainable earnings are the foundation for reliable dividends. Second, examine debt levels and cash flow. A company that relies heavily on borrowing to pay dividends is vulnerable during economic downturns. Similarly, check whether cash flow comfortably covers dividend payouts. The goal is a payout that is supported by real earnings, not paper profits or temporary measures.
Third, assess payout ratios. A high payout ratio may indicate that the company distributes most of its earnings, leaving little room for reinvestment or unexpected challenges. Graham preferred companies with balanced payout ratios, enough to reward shareholders, but not so much that financial flexibility is compromised. Fourth, analyze management quality. Consistent dividends often reflect prudent leadership, disciplined capital allocation, and a long-term focus on shareholder value. Conversely, frequent dividend changes, aggressive borrowing, or opaque reporting can be warning signs. Finally, consider market context and sentiment. High dividends can attract attention, but investor hype does not guarantee sustainability. Conversely, a temporarily reduced dividend might signal careful stewardship rather than weakness. By combining fundamental analysis with an understanding of market psychology, investors can identify companies with reliable income and enduring strength. Whether you are a defensive investor seeking steady income or an enterprising investor balancing yield and growth, Graham's methodology offers a clear framework. By focusing on earning stability, financial health, management prudence, and margin of safety, you protect your capital and ensure that dividends remain a source of dependable wealth. Yet all these lessons ultimately converge on a single enduring principle. Benjamin Graham's teachings on dividend safety and income consistency are not relics of the past, they are timeless guidance for any investor seeking both stability and growth. He taught that dividends are more than payments. They are signals of financial health, management prudence, and long-term resilience. The key takeaways are clear. First, focus on sustainability over yield. A moderate, consistent dividend backed by solid earnings and cash flow is far safer than a flashy, high payout that hides risk. Second, examine financial fundamentals. Earnings consistency, manageable debt, sufficient cash flow, and prudent management all contribute to dividend reliability. Third, understand the influence of market psychology. Investor sentiment can distort perceptions of safety, but careful analysis reveals the underlying truth. By applying these principles, you can identify companies that not only pay dividends today, but are likely to continue doing so for decades. You protect your capital, avoid dividend traps, and cultivate a steady, reliable income stream, a foundation for long-term wealth. Graham also reminds us of the value of patience and discipline. Markets are often volatile, and opportunities to buy high-quality, dividend-safe companies at reasonable prices may be rare. Waiting for the right moment and evaluating each company rigorously is not an activity, it is strategic foresight. Ultimately, the wisdom Graham offers is simple yet profound. The path to reliable income is not in chasing headlines or short-term rewards, but in careful analysis, rational judgment, and respect for the fundamentals. In every era, from the industrial booms and busts of the early 20th century to today's fast-moving markets, these lessons remain as relevant as ever. By embracing Graham's approach, investors gain more than just dividends. They gain stability, clarity, and confidence, navigating uncertainty with the timeless principles of a master who understood that true wealth is built not on speculation, but on discipline, prudence, and enduring value.